What if I told you that there is a simple investing strategy that could outperform the market? And no, it's not some complex algorithm or a secret formula only known to Wall Street insiders. It's an updated version of a classic approach that's been helping investors build wealth for decades. You've probably heard of the three-fund portfolio, a straightforward investing strategy that's been a staple for many savvy investors. It's elegantly simple. One fund for US stocks, one for international stocks, and one for bonds. But here's the thing. The financial landscape has changed dramatically since the strategy was first introduced. In today's rapidly evolving market, is this traditional approach still the best way to grow your wealth? Or is it time for an update? In this video, we're going to dive deep into a modernized version of the three-fund portfolio. I do struggle to count. Former banker here, you see. And it's tailored specifically for now and beyond. And we're going to explore how you can boost your returns, streamline your investing process, and set yourself up for long-term success, all while keeping things refreshingly simple. Whether you are that seasoned investor looking to optimize your strategy or a complete newcomer trying to make sense of the stock market, this updated approach could be exactly what you need. So grab a cuppa and let's get started on revolutionizing your portfolio. And if you get some value out of this, well, smash the subscribe button. And we've got 2 videos a week coming out with pure, unadulterated. So let's dive into why we need to update the traditional three-fund portfolio first. The global financial landscape has changed. Be fair to point that out, right? We've seen big tech advancements that reshaped industries. Companies like Amazon, Apple, and Google have become giants, dramatically altering the composition of major indices. Pretty much whatever index you buy, there is always Apple at the top. So we need to adjust for that. Secondly, we've got very low interest rates by historic standards, even despite what the Fed did in 2023 and 2024 for very long times. And that has also changed the role of bonds in a portfolio compared to, say, the 70s. And lastly, the line between domestic and international markets has become a lot more blurred. Many US companies now get a lot of their revenue from overseas. Netflix, I think, is about 40% international revenue. Microsoft isn't far behind. So by buying certain US stocks, you're actually investing overseas already. And these changes have exposed some limitations in the traditional three-fund approach. Let's break those down. 1, the traditional US stock fund might not capture the full potential of higher growth sectors. Think tech, think innovation. With very low bond yields, the bond portfolio might not provide us much income, nor even the stability it once did. And then the separation between US on the one hand and international stocks on the other hand, it's become a lot less clear, which means there's a lot more overlap, and it's reduced the diversification benefits of that old system. So how do we address this? Well, enter the ETF, or the exchange-traded fund. These investment vehicles offer a modern solution to our portfolio conundrum. ETFs provide several advantages over traditional mutual funds: lower cost, greater transparency, and the ability to trade them whenever you want. We can also target specific sectors, themes, or investment strategies with a lot more precision, and without making the mutual fund people rich. So by using ETFs as the primary building blocks for our updated three-fund portfolio, we can create a much more flexible, cost-effective, and therefore higher performing investment strategy. So the next section, we're going to delve into each of these components. Now you might be thinking, Felix, there's a lot to this. Well, I have actually made a workbook for you that you can download for free at felixfriends.org/ETF. felixfriends.org/ETF, and the link is down below. And that has checklists in them and runs you through each part to make sure A, you understand it, and B, you've got some summary notes that so you know what you're running through. So we're going to explain how these ETFs can work together to supercharge whatever it is you want to supercharge for. So our updated portfolio consists of 3 carefully selected ETF categories, each serving a specific purpose for our strategy. 1. the foundational ETF. It's sort of the bedrock of your portfolio. It's a broad-based market index ETF. Gives you lots of exposure to a wide range of US companies across various sectors. Gives you stability, steady growth, much like the traditional US stock fund, but with the added benefit of the ETF structure. Second component is the dividend ETF. And this is your income generator. It replaces the traditional bond fund. By focusing on dividend-paying stocks, we aim to provide more steady income, while still offering some potential capital appreciation. So have your cake and eat it, that's really the goal. And then third, we add the growth ETF. Here's where we capture that exciting potential of high growth sectors and innovative companies, and that replaces the international fund. And it recognizes that many US-based companies now have that global exposure anyway. So I think we take down the risk a notch by reducing foreign exposure, bloody foreigners everywhere, and therefore currency exchanges and just markets that maybe we don't understand as well and have a lot more risk than the US. By combining these three ETF categories, we aim to create a portfolio that's diversified, balanced between stability and growth potential, and adaptable, yet still refreshingly simple to understand and manage. Only 3 tickers. Let's dive deep into the first pillar, the foundational in ETF. Now, as I mentioned, we use the ETFs because they have very low expense ratios and therefore more of our money stays invested, and it really makes a huge difference over time. Over the long term, the US stock market has shown tremendous performance, at 10.5% over the last 30 years, each and every year for the S&P. So let's talk about 2 specific ETFs that I like the smell of for this foundational role. There is VTI and VOO. These are also in the document you can download at felixprehn.org/ETF, so you don't have to take as many notes. VTI is the Vanguard Total Stock Market ETF. It tracks the CRSP US Total Market Index. What? Basically, it covers the entire US stock market. Small caps, mid caps, large caps, the whole thing. If you want to go a little simpler, you go for VOO, which is the Vanguard S&P 500 ETF, which tracks just the S&P 500. So it focuses on the largest 500 profitable US companies. Both of these ETFs have super low expense ratios, 0.03%. So for every $10,000 you invest, you're paying $3 in fees per year. That's very much a bargain. What about performance? Well, both ETFs have closely tracked the performance of the S&P over the past decade. VTI has slightly outperformed because smaller companies have done a little bit better. But there are some considerations you need to keep in mind here. There is market risk still. So when the US market goes down, these ETFs will follow. They don't provide any downside protection, like maybe a bond might. So the market will drop 30% and again 50%, possibly even 70% during your lifetime. And you need to know that that's going to happen and look at a stock chart and say, well, every single time that has happened, the market's recovered afterwards. And anybody who's ever held stocks for a long period of time has always made money, especially if they bought a broad market index fund. So which of these do you choose? Well, if you want the broadest possible exposure to the US, go with VTI. If you're comfortable focusing just on the largest established players, VOO is your bet. Either way, you're going to get a solid foundation for your portfolio at a very, very low cost. Now, let's build the second pillar here. That's the dividend ETF. And you might be thinking, Felix, why are we replacing bonds with dividends? Well, let me explain. As I'm recording this, we're in a phase where we expect the Fed to cut interest rates further. One, while falling interest rates can be temporarily good news for bondholders, what it actually means is that for the long run, and we're building a long-term portfolio here, you're going to get less interest, right, for your later investments. And that isn't really great, right? Who the heck wants to make 2 or 3% a year? So by using dividend stocks, we typically see those dividend payers increase their payouts over time. And it might help you, therefore, keep pace with inflation. And they have growth potential because there is a possibility of capital appreciation as well as income appreciation. So you get 2 ways to get that wealth. And they tend to be relatively stable. companies that consistently pay dividends tend to be more established, tend to be in a market that is somewhat grown up, and therefore they have spare cash to pay out. Now, there are two ETFs that I like the look of, and that is SCHD and VIG. Again, the tickers are in the document, felixprehn.org/ETF, links down below. SCHD, or the Schwab US Dividend Equity ETF, tracks the Dow Jones US Dividend 100 Index. It focuses on quality companies with a history of consistent dividend payments. VIG, which is Vanguard's sort of equivalent, tracks the US Dividend Growers Index. It emphasizes on companies with a track record of increasing their dividends over time. And both offer, again, super low expense ratios, 0.06%, which is $6 on every $10,000 invested every single year. I think that's a great deal. If we compare these two, well, SCHD offers a higher yield at present. VIG tends to have a stronger focus on dividend growth. So your choice is between, well, do you want income now, or do maybe you want longer term dividend growth? Now, there are some drawbacks with dividends. There are tax implications. If you're doing this in a taxable account, dividends are generally taxed as income, which can be a lot less efficient than capital gains depending on your income bracket. So you might want to consider holding these in a tax-advantaged account if possible. Dividends companies also tend to be in sectors like utilities, consumer staples, and financials. So you might be putting a lot of your exposure to these sectors and therefore maybe foregoing some of the high growth sectors like technology. We're going to address that with Pillar 3, but just wanted to be aware of it. And there is an interest rate impact. It's less direct than with bonds, but dividend stocks can be affected by interest rate changes. As rates potentially fall, it could actually benefit dividend stocks, but it's definitely something to keep an eye on. But there is less downside protection. If you buy a government bond, say a 10-year government bond, it's very likely the government's going to pay you back at the end of that 10-year period. With a dividend stock, it's still possible that they go out of business. Although an ETF somewhat cushions you from that because it'll just be one of many stocks. So let's dive into pillar number 3, the growth ETFs. And that's where we are making a significant shift from the traditional approach. We're replacing international funds, which I think are typically high fees, high risk, high currency risk, and we're replacing it with US growth stocks instead. So the benefits are innovation. These ETFs often have significant holdings in sort of new sectors like tech and biotech and clean energy and so on. And there's therefore more high growth potential as we're looking to supercharge our returns. And you get indirect global exposure still. Many of these high growth companies have global operations. They provide therefore still some international diversification, as does most large cap investing anyway. Now, there are two ETFs that I quite like in this space. One is QQQ and the other is VUG. Now, QQQ, probably the most famous ETF out there, tracks the NASDAQ 100 index. It's heavily focused on tech and innovation-driven companies. I've recently started buying QQQ or some variation thereof, which is slightly more tax advantageous for a non-US taxpayer like myself. VUG is the Vanguard Growth ETF, which tracks the CRSP US Large Cap Growth Index, offering broader exposure to growth stocks than just the QQQ, which is only 100. Expense ratios, QQQ is 0.2%, which is a little lofty. VUG is 0.04. Now, QQQ does, however, offer very concentrated exposure to many of the world's greatest companies. It's heavily tilted towards tech, while VUG offers a bit more of a diversified approach to growth investing. What about the historical performance? They've both significantly outperformed the broader market over the last 10 years. Now, past performance doesn't necessarily guarantee future results, but it's an interesting number to look at. What are the downsides to growth investing? Well, there's more ups and downs, basically. It's more volatile, and therefore you need to be able to stomach short-term fluctuations, which basically means, what if the thing drops 30 or 40 or 50%? Are you still holding and are you still buying? The answer is yes. then it's maybe for you. If the answer is no, you should probably go for something more steady. There is also a lot of sector concentration, particularly the QQQ. You get a lot of tech sector exposure. And that could be great. You could have more gains, but it also gives you more volatility. And there is also a fair overlap with the S&P and the QQQ. A lot of the big tech stocks are in both. And growth stocks tend to perform best in bull markets, but they might underperform during downturns when value stocks tend to have a comeback. So which ones would you choose? Well, if you're comfortable with higher volatility, you want more concentrated exposure to innovation, QQQ might be your cup of tea. If you prefer a more diversified approach, then VUG might be a better choice. So align this with your risk tolerance and be honest with yourself. Talk to your stomach lining on that front. But by incorporating a growth ETF into our updated 3-fund portfolio, we're aiming to capture the potential of innovative high-growth sectors in the US and remove some of the international risk that maybe we just don't want. So how are we going to put all these components together? It might be tempting to simply allocate a third of your portfolio to each. I would recommend a little bit more of a nuanced approach based on your age and your risk tolerance. Let's look at a sample allocation for different age groups. So for young investors, if you're in their 20s or your 30s, I'd maybe look at 40% in the foundational ETF, 20% in dividends, and 40% in growth. And that leans into growth potential because you've got a long investment horizon in front of you, many months of adding to that portfolio. If you were in your 40s and 50s like me, maybe 40% in the foundational, 30% in dividend, 30% in growth. We started to dial back the growth and risk components a little bit, bring in a little bit more dividends, but only do that if it's in a non-taxable account, please. If you're getting to near retirement, 60s and beyond, I would look at 35% foundational, maybe 45% dividend and 20% growth. So you see less ups and downs because you might actually be drawing from this portfolio now rather than adding to it. Now, these are, of course, just starting points. So it's crucial to personalize your allocation based on your own risk and your own tolerance and your own financial goals. Someone in their 50s with a high risk tolerance might prefer an allocation closer to the younger investor, while a risk-averse 30-year-old might lean to a more conservative mix. You only know who's right and wrong for you. The perfect allocation is essentially this. Does it let you sleep well at night? Yeah. Well, still moving towards your financial goals. So don't set up stuff that's going to make you break out in a sweat when you turn on your broker in the morning. I recommend reviewing your portfolio at least once a quarter. Once a month is also quite a nice thing to do. I would look less at what has performed well and more at where have I contributed. But on an annual basis, you might want to readjust your fresh money allocation on the basis of the bits that have underperformed. So say the dividend stocks are not doing as well and everything's running up in the growth stocks, then maybe you want to contribute a little bit more to the dividend stocks, and that'll help balance things out, and it'll also help you buy cheaper stocks at that particular moment. And consider consulting with a financial advisor. Now, I know a lot of them aren't great, but I'd look for one who's actually going to charge you an hourly rate and just say, I want to pay you an hourly rate. There are plenty of them out there. And that way you're going to get some independent advice. And you're going to say to them, I'm not going to buy anything from you. I'm just going to get your advice. And it'll help you align your strategy with where you actually want to get to. And I do this as a family. I bring your partner, bring your children, no matter the age, because they will learn financial planning. And that's going to get them to financial freedom that much more easily and without as much struggle as it may or may not be for you. And investing is a journey. It isn't a destination. Not every week and every month is going to be the same. But by doing those monthly reviews or at least quarterly reviews, you will know where you're going and you have opportunities to course correct because you're not just driving with your eyes closed. And that's what's going to help you tremendously. So how do we put this into action then? Well, it's a lot simpler than you think. Number one, assess your current situation, take a look at your existing investments, and consider your financial goals. Are you starting from scratch, or do you need to make adjustments to your existing portfolio? And step two, choose your ETFs, select one from each of the 3 categories. And then in step 3, determine your allocation based on your age, your risk tolerance, and decide your target allocations. And then 4, Open or update your brokerage account. If you don't already have one, open one. Many online brokers offer commission-free trading for ETFs, making this strategy cost-effective to implement. We've done a whole video reviewing brokers on this channel, which you can find fairly easily. And make your initial investments then. Start by investing in your chosen ETFs according to your targets. If you are moving from existing investments, you got to look at tax implications and make sure that you're doing it right. And a lot of brokers also offer automations, and I'm a huge fan of that. Say on the 1st of each month, if you get paid on the 31st, it'll automatically suck some money out of your savings account and it'll automatically buy certain ETFs. And that way, you're not going to forget it and you're not going to skip it and you're not going to spend the money on some other nonsense, and therefore you're going to get to your financial goals. For those of you who already have an existing portfolio and you're thinking about rejigging it, before you sell anything, talk to a tax advisor, or at the very least, ask ChatGPT or what the tax applications are. It's a good place to start. It's not advice, obviously, so that you know what's coming there, right? So you don't want to be surprising yourself with a tax bill. But the most important thing, the most vital thing of all of this is consistent contributions. Consistency is what makes people money. And I teach people how to invest and how to trade. And the old rule is always, look, I could give you all the trading and investing rules in the world. I could put them in a newspaper, but most people won't take any action because most people don't take consistent action. If you can take consistent action by perhaps setting up automatic monthly or even bi-weekly or even weekly investments to align with how your income comes in, then you'll be ahead of 99% of people. Stay curious, keep learning, and be ready to adapt your approach as your life changes, puppies, children, marriage, whatever it might be. And if you want to get the most out of this video, download the workbook I made for you at felixprehn.org/ETF. And if you got some value out of this video, well, share it with a friend who might also get some value out of this. I love you for watching. Thank you for joining me on this journey through the reworked world of modern investing, and until next time, all the best.